This video covers some potentially bullish developments pointing towards a rally attempt or bottoming process in risk assets occurring sometime between late May and early June 2012. In the first half of the video, we discuss updated versions of charts that we've presented in recent videos or recently on Short Takes, our blog. In the second half of the video, we cover positive divergences or potentially bullish setups in these assets and negative divergences or possible negative or bearish setups in U.S. Treasuries and the U.S. dollar. The best case scenario, and this takes into account current DeMark exhaustion counts, would be one more bout of weakness in risk assets sometime in the next 1 to 3 weeks. So weekly chart of the DAX looks complex. Concept's very easy. First, this chart was originally drawn with high-low closed bars. That's why some of these lines don't match up. The reason why we have it here with just closing prices is we had an expectation that we were going to hold in here. We didn't. So when you save the chart with just closing prices, you can see that near these blue arrows, there's some support. The point of showing it's pretty simple. If we don't hold here relatively soon, you can make a case that the DAX could fall another 4% relatively quickly. But we do have a chance to hold in here. We held there, here, roughly here, and here. European financials, we showed this before, point's relatively simple. Right now, we're holding in near these lows, and for now, that's a good thing. If we break below there, it could be like the October 2011 lows for the S&P 500, where it could do one of two things. The trend could accelerate to the downside, or it could be a head fake, where you get the last round of sellers to sell out, and then we reverse. We'll just have to see how it plays out right now. This is still support and relatively bullish as long as it holds. This is foreign stocks, EFA, ETF. Concept here relatively simple. This was a head and shoulders pattern that seems to be forming. We're holding above this, so this is still support here. If we were to break this, you could make a case from the head and shoulders targets that we could fall all the way down to 33.55, which is about a 27.5 point decline. This is the same chart weekly, showing you that there are several forms of support that could still hold here. Somewhat of a bullish case is intact. I'd say as long as we stay above 46, then things could get ugly if that gives way. This is the equal weight S&P 500 ETF. You can see that things tend to be good when you're above these two blue lines, and things can get ugly when you're below them. Right now, we're testing them. This is also the 50-week moving average here in blue. So right now, it seems to be holding. If it doesn't hold, we could also see an acceleration to the downside. No need to guess here. We can just pay attention to what's going on and react accordingly. S&P 500 daily. This blue line is the 390-day moving average. You may say 390-day. Why are you using that? We use it because the market seems to think it's important. The S&P 500 held near it 3 times here. It acted roughly as resistance here, support here, etc., etc. The market tends to be healthy when you're above it, unhealthy when you're below it. Good things tend to happen above it, shaky below it. We're still above it, and if it were to act like support like it did here, that would be good news. It could also break through and accelerate to the downside, so it's just something that we're watching. It's currently at 1285.90 as of Thursday's close on May 24th. This shows you where a head and shoulders type pattern held and did not have bearish implications. This is a long-term weekly trend line going all the way back to 2007. Resistance, resistance, resistance. It's trying to act as support. As long as it holds, we got hope for a bounce. If we break through here, obviously it's not good. Noisy chart. Concept, very, very easy. These are parallel trend lines, blue, pink. These are parallel, these green lines. The point is, if we break into this white space here, you could make a case that we could move to 1350 relatively quickly. Right now, this is still resistance. This is a daily chart. What once was support in here is now resistance. So the point being, these support lines are now potential forms of resistance. If you could see that the S&P 500 can clear 1340-ish, which is this line here, and if it can also clear this exponential 20-day, it also says that we could get a relatively quick pop higher. Whether or not that's a head fake remains to be seen. This is the head and shoulders chart that we've shown previously. Right now, the target with the green line seems to be holding. One of the targets, you can't see it here, but that's 1306. We're trying to hold in here, but if you know candlesticks, these three candlesticks here really don't incite a lot of confidence. However, we are holding here. This is a nice candlestick, and a case can be made that this head and shoulders pattern played out with this being the neckline, and this would be a logical place for support. If this doesn't hold, we could easily see us moving towards 1280 or 1260 on the S&P 500. This is the Vanguard All World X the United States. Here's the trend line that we've shown. It held here, it held here. It's still trying to hold, so as long as this holds, there's a bullish case. If we get a close below it, then the bearish case starts to pick up steam. Now we're going to look at some potentially bullish and bearish divergences that are showing up on weekly and daily charts. As we scroll through here, obviously at any point you can pause your video player down here in the corner. Anything that occurs in technical analysis on a weekly chart is more important than anything that occurs on a daily chart, and anything that occurs on a monthly chart is more important than a weekly chart. So as we go through these, the majority of them are weekly charts. Some of them are daily charts. You can discern the importance of the signal based upon whether it's a daily or a weekly. What are we looking at here? This is a historical example to show you why this can be important. This is price, and all we're doing with these aren't trend lines. We're just connecting points. So this is a low, this is a low. You get what's known as a bullish divergence when price makes a lower low, so this is lower than this, and an indicator makes a higher low. So this is a big, huge jump up and down, glaring bullish divergence at these March 2009 lows, and it occurred on a weekly chart. Some of the ones that we're going to look at now aren't this pronounced, but when you have bullish divergences on weekly charts, what it's telling you here is that the bears are losing their grip on the market and losing their enthusiasm to sell. And what you've really got here, this is the last wave of sellers that finally throw in the towel. And this divergence tells you from a probabilistic standpoint that this is a good entry point, especially once price confirms it and moves off of it. So everything in technical analysis, and in life for that matter, concerns probabilities. So the fact that we're seeing bullish and bearish divergences on some of these charts that we're going to show you doesn't mean anything until price confirms it, and even after that, we're still just looking at probabilities. Now we're fast forwarding to the present day. This is the euro on a weekly chart. We're connecting points here. Again, this is not a trend line. This point and this point. When we made this new low here, MACD was all the way down here. We're making a much lower low here relative to this point, and MACD is making a higher low. That's a pretty pronounced bullish divergence here. And if you understand the markets, when the euro has been weak in recent years, really, it tends to be risk off. When the euro is weak, the dollar is strong. So what this is telling you is this divergence is saying Stocks could bottom relatively soon. The dollar could reverse relatively soon. And if you're loaded up with treasury bonds or bonds of really any kind, the more conservative they are, the higher the risk they would be for a reversal. Again, speaking in probabilities here, but out of the divergences we're going to look at today, this is probably the most pronounced one and the most bullish. How you use it, it just tells you to pay attention. Price needs to confirm it. Other things need to happen. The divergence in and of itself is not a reason to buy. This is the Swiss franc weekly. Another bullish divergence. This is commodities. We're looking at this point. Here's a low relative to this point. Again, not a trend line. This is sloping upward. This line is sloping downward. That tells you you have a bullish divergence. This bullish divergence could easily be erased. If commodities tank here, eventually this could make a lower low below this. So as long as the divergence is in place, it just says pay attention. Agricultural commodities, it's a pretty big divergence. And look how long it's been since agricultural commodities have made any kind of stand. So agricultural commodities, especially if they print money, are something that are worth keeping on your radar. Right now, they're entrenched in a downtrend and they're extremely weak, so something has to change. This is natural gas, stocks, the slope of this line down, the slope of this line up. That's a bullish divergence, just says be open to a rally in FCG. Germany, again, we're looking at point to point, this point and this point, versus this new low and where this indicator is here. So that's why it doesn't really matter that we're drawing through this. It's a bullish divergence, says be open to a reversal in EWG and the DAX. This is commodities again, bullish divergence on a weekly chart. Treasuries. Now this is what's known as a bearish divergence. And the fact that I have a bearish divergence, potentially bearish divergence is the way it should be phrased. Because in and of itself, nothing's bearish about treasuries, particularly just yet, as far as price action goes. Price makes a higher high, and you can see the indicator makes a lower high. The slope of this line for price is up. The slope of this line is down. This is a pretty pronounced bearish divergence that says be open to a reversal in treasuries, and if treasuries are going to reverse in a bearish manner, that would tend to be bullish for the euro, it would tend to be bullish for commodities, bearish for the dollar, and bullish for stocks. Silver, if you're a gold bug or a silver bug, this isn't one of the better divergences, but it is a divergence. Silver is firmly entrenched in a downtrend. I've owned silver before numerous times, haven't owned it for some time now. Would love to get a good re-entry point relative to the money printing and those things. I'm not so sure this is a long-term entry point if we get one, but we have to be open to silver and gold moving higher. Italy, this is a pretty significant bullish divergence. Slope of this line significantly down, slope of this line up. So this says if you're long the dollar, this is a fairly significant and potentially bearish divergence for the dollar and a bullish divergence for this fund, which makes money when the dollar goes down. Symbol UDN. Here's the mirror image of it. This is if you own the dollar and you're bullish on the dollar. So the US dollar has made from this point to this point a higher high, and you can see the indicator has made a much lower high. It says that this move off of this low for the dollar could be getting long in the tooth, but this could be erased. But for now it's intact, and it says if you own the dollar, you should pay attention. It can be somewhat of a leading indicator, and you've got a potentially bullish divergence. It's only on a daily chart, which means it's not as meaningful as the ones that we've seen on weekly charts. This is shorting treasuries, a double short of the 20-year U.S. Treasury bond. This is a fairly significant bullish divergence on a weekly chart. If this were to move higher, that tends to be bullish for risk assets and bearish for treasuries and bearish for the dollar. Look at small caps. This divergence isn't that great. It's on a daily chart, but it does say be open to a rally in small caps of some kind. Price needs to confirm it, but you can see here we have had a move, and you're looking at the low versus a low for this exercise. And divergences, Spain, this is a weekly, fairly significant divergence, saying be open to a rally in Europe and in Spain. Gold, this is a daily chart. Again, not that great of a divergence, but if you compare the slope of this line, it's a divergence. This one's moving up, this one's moving down. Regional banks, daily, clear lower low. This is sloping upward. Bullish setup. Telecom, bullish, shorter term daily. Not a great divergence, but a divergence. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.